If you're looking for the brutal, honest truth about dividend investing, well, investors, I want to go ahead and just spill all of the beans for you. It is flipping awesome to receive passive income every single month for doing absolutely nothing. However, that's not the truth that I want to share with you. But before I get real and open up about the one strategy as a dividend investor that has really allowed my portfolio to truly flourish, I want you to go ahead and light up that thumbs up button for me. And with that, we'll now go ahead and get going. So now, if you've been with me on this journey over the last year or two, you obviously know that I am just all about dividend stocks. I mean, heck, I am posting videos every single week about which ones are hot buys, which dividend stocks should be on your watch list, or even kicked off a new dividend series rather recently called Masters of the Market, to which I'm talking to dividend investors about their journeys in becoming dividend millionaires. Which, by the way, if you're looking for all of those stock ideas or looking to catch those Masters of the Market chats, be sure you're subscribed to the channel. Anyhow, I just want to open up to you about this little secret. Actually, not so much a secret, but my personal strategy that has been just really setting me up for success ever since I implemented it. And I'm talking about beyond measure. And I feel that while so many of us are just hooked on generating passive income with dividends, which again is incredibly exciting, we really are just missing out on the point of what we're actually trying to do, which is likely to achieve financial freedom, retire a little bit earlier, or retire a bit more comfortably, all based not necessarily on dividends, but rather on a total return basis, which means it's not all about how you get there, but rather that you actually get to the goal if you get there at all. Now, is this dividend investing snowball effect real? You know, the process where reinvested dividends are used to purchase more shares of a stock, which then generate their own dividends. Is that a real thing? Yes, 100%. But let's just be real. No one's getting any younger, and more importantly, none of us have the time to waste on making the mistake that, let's just be brutally honest with ourselves, all of us make from time to time, picking a loser, sticking with it, and ultimately just losing money. Therefore, I'm here to talk to you about the very first move that I think you should make if you are a new dividend investor or a new investor in general, which is getting yourself set up with an investment foundation that you will, no matter what, just continue to invest into every single week or every single month, and you just keep buying it because investing is that simple. And from there, you can then actually look to take some really important, and I mean crucial action steps, like upping your income to feed the dividend beast that you ultimately create, because as we know, money makes money, and more money, well, makes even more money. So here we go with a plug for exchange traded funds, or ETFs for short. Now, investing into an ETF is an investment into a basket of stocks, which allows you to totally eliminate the headache of trying to pick the needles in the haystack, and more importantly, will relieve you of all of the worry and panic of panic selling when the market actually gyrates, which it always eventually does. However, the question here comes down to which ETF do you pick, because we are faced with hundreds of choices in which, I gotta be honest, most we should just ignore. Now, if your head is in the dividend investing game entirely, SCHD, the Schwab US Dividend Equity ETF, is very likely the ETF that you've heard of, and therefore I want to quickly dive into what it gives you as a dividend investor, and then reveal why I'm actually not invested in it, despite the claim to fame of this ETF being for all dividend investors. So opening up SCHD's summary, we can see SCHD was designed to track the total return of the Dow Jones US Dividend 100 Index before all fees and expenses. And scrolling down to the fund's profile, we can see that it's made up of 103 total holdings that nets out to just over $54 billion in assets, breaking down into a wide array of sectors, with 17.42% of the fund's holdings in financials, 15.71% in healthcare, another 13.89% in consumer staples, 13.51% in industrials, and 12.84% in energy, before scattering into the other sectors. But going a little bit more beneath the hood here, we can see that the fund's largest holdings come down to Texas Instruments, Amgen, Lockheed Martin, Coca-Cola, Pfizer, Chevron, Verizon, Pepsi, Cisco Systems, and Larry Fink's BlackRock, which all tells me that this fund is really going to give you as an investor more stability through both the good times and, more importantly, the bad times, which is important if you are up there nearing retirement. And it's also going to shell out a dividend yield here at 3.92%, to which you'd only be paying $6 per $10,000 invested annually, thanks to a lower expense ratio coming in at just 0.06%, all meaning that a $10,000 investment made 10 years ago would have blossomed now into roughly $27,984. Not too shabby, but also, I gotta be honest, not the best investment move that you can make, especially if you have a longer period of time on your investment timeline, to which all of you younger investors now should be paying attention. You see, that fund, SCHD, in comparison to the two other funds that I have in mind for you, is there at the bottom. It's a solid fund, but it's not exactly the winner, so I at least want to run through two other ETFs with you that, if you have some decades worth of time to go, are going to be a better fit. And that's not just on the 5-year time span, but the 1 year as well. And even if we click into the last 30 days, we can still see SCHD is not the ideal. So we're just going to go ahead and get going here. The truth that I want to share with you, it all comes down to cementing an investment foundation with the good old S&P itself. And you could do so with either of these next two funds that we're about to break down. We're going to start with the State Street Global Advisors SPDR S&P 500 ETF, ticker symbol SPY, which was launched back in 1993 and was actually the very first ETF listed in the United States, and simply seeks to provide investment results that correspond to the price and yield performance of the S&P 500. Of course, then we would get a slice of a bigger pie here with 503 total holdings, given it's the S&P 500, covering mainly now technology, as it makes up 32.8% of the fund, before covering financials at 12.2%, healthcare at 11.8%, consumer discretionary at 9.7%, and communication services at 9.2%, working out to Microsoft and NVIDIA as the largest two holdings, followed by Apple, Amazon, Meta, Google, Broadcom, Berkshire Hathaway, and Eli Lilly. And though only shelling out a 1.2% dividend yield with an expense ratio at just 0.0945%, the proof of SPY's power lies in the performance, as a $10,000 investment would have soared to $33,334.91. But if you want my personal pick now for an investment foundation, just being a Vanguard guy myself, my go-to is the Vanguard S&P 500 ETF, that's ticker symbol VOO, which was designed to do exactly the same thing as SPY in terms of tracking the S&P. So let me just go ahead and pop open the Vanguard app here on screen for you, and we can see in terms of VOO a dividend yield coming in at 1.29%. That's a notch higher than SPY, and a notch cheaper there in terms of the expense ratio at 0.03%. Now scrolling down, we have a similar makeup, whereas 30.6% of the fund's weight is there in tech, 12.9% in finance, 12% in healthcare, 9.8% in consumer discretionary, 9.3% in communication services, with Broadcom, JP Morgan, Eli Lilly, Berkshire Hathaway, Meta, Amazon, and NVIDIA, Google, Apple, and Microsoft all coming in as the top 10 holdings of VOO. But performance-wise, again, here's where we get the real magic, because a $10,000 investment into VOO made a decade ago would have morphed into $32,911.45. That's a whopping 12.65% average annual return rate, and just in the last year alone, a 28.15% return, meaning chasing dividend yield is all fun and games, but if you're really looking to drive a total return, do not get sidetracked by all the fun of dividend investing or what it looks like, because it's actually all about setting yourself up well for the future. So stop trying to get rich by Tuesday, scale your investment foundation, and really set yourself up for success with an S&P fund. Now, investors, I'd actually love to catch your thoughts on dividend investing truths that you have, these ETFs that I mentioned, and more importantly, which ETF you have as your investment foundation and why. Drop all your thoughts down there in the comments below. Join me here weekly by subscribing to the channel right now to never miss a video. And then really, you could just actually click right here for more insights now.